mortgage insurance.
Just kidding. PMI has a terrible stigma around it, but it's actually what allows millions of Americans to become homeowners every year and escape the wraths of renting. If you don't have 20% saved to put down on a home, first of all, don't worry, you're not alone. The average first-time homebuyer puts down just 7%. And second, you're going to need mortgage insurance. By the end of this video, you'll really understand what mortgage insurance or MI is, what the best option is for you, and how to get rid of mortgage insurance. So before mortgage insurance existed, if you didn't have 20% to put down on a home, you could not buy a house. You didn't have any options until you had that 20%. And then private mortgage insurance or PMI companies were created. So just like life insurance or health insurance, in the event that you cannot pay your mortgage back, the mortgage insurance kicks in and gives the bank back the money that they lost. So PMI is not some evil thing that mortgage companies are trying to screw you over with. It's literally a separate company that protects them and insures them in case you default. But anyway, now that we have that out of the way, let's back up a little bit. There are two types of mortgage insurance. This is really important. If you're getting an FHA loan, you'll have what's called a mortgage insurance premium or MIP. MIP is a set percentage of your loan amount. Doesn't matter what your credit is. If you put down less than 10% on an FHA loan, you will have the mortgage insurance premium for the entire life of the loan. This means until you sell your home, until you pay off the mortgage, or until you refinance. So that's FHA loans. Conventional is a little more complicated. Conventional loans have your PMI and the rate is determined based upon your credit, your loan amount, how much you're putting down. There are 5 private mortgage insurance companies and your loan officer will shop for the best rate for you. I have seen mortgage insurance as low as $17 for someone who's putting down 15% and has good credit, and I've seen it as high as $300 plus for someone who maybe has a lower credit and is only putting 3% down. There are a lot of factors that go into determining your mortgage insurance rate, and there's really no way to know exactly how much you'll pay in mortgage insurance until you talk to a lender and have them give you an estimate. So here's the kicker. With conventional, your mortgage insurance can be canceled, meaning you never have to pay it again when your loan to value ratio is at 78%. So just for example's sake, to make it easy, if you purchase a home for $100,000, if you put down $10,000, that means your loan to value is 90%. So once you've paid the loan down to $78,000, that's when you'll never pay the mortgage insurance again. Now, you can legally request for your mortgage insurance to be canceled when you have 80% loan to value. So when your loan is at $80,000, which will probably be a year or so sooner than the $78,000. So if you put down less than 20%, you always want to pay attention to where your loan balance is at and what your loan to value ratio is. But realistically, for most people, you'll either refinance or sell before that time comes. That's it. PMI is not nearly as scary as it seems, and for most people, it's better than continuing to pay rent for as long as it will take them to save up the 20%. If you're thinking of buying your first home in the next year, sign up for the Homebuyer Workshop. I'll link it below so you can learn everything you need to know about buying your first home, how to make the process easy, and all of your first steps. I'll see you there.